Imagine this. You're stepping into a luxurious jewelry shop, but instead of leisurely examining diamond rings or glimmering necklaces, your eyes are drawn to a staggering sight. The price of gold is skyrocketing, soaring higher than you've ever imagined. It's not just $1,000 an ounce. It's not even $2,000. No, we're talking more than $3,500 an ounce. Now that's not a made-up story. That's our real life right now. Gold has shattered all previous records, and people everywhere are asking an urgent question: why is this happening? And here's where it gets interesting. Gold doesn't move on its own. It's like a mirror reflecting our deepest fears about the economy, politics, and the future of money itself. Welcome back to BrainFuel Reads, where we dive into ideas that matter, whether it's science, the economy, or the hottest debatable conversation. So in today's episode of the What If series, we're going to explore this. What if gold has finally peaked? What does that say about the Federal Reserve, about trade policies from the Trump era, about inflation, about the dollar, and most importantly, about your money? This discussion extends beyond the gleam of gold bars tucked away in vaults. It's about the deeper story they reveal. Let's unravel this mystery together. Let's kick things off with the undeniable truth. Gold has never been this expensive. Over $3,500 an ounce is a monumental price tag. But here's the thing. Nobody wakes up and says, "I just love gold for its sparkle." The reality is that investors turn to gold when they're nervous. They're jittery about the stock market taking a nosedive, the dollar's value dwindling, or inflation gnawing away at their hard-earned savings. Gold is often referred to as a safe haven. Think of it as a lifeboat amidst a stormy sea. When global conditions feel unstable, the allure of gold becomes irresistible. So when you observe gold prices shooting up, it's not just a number on a screen. It's a cautionary tale, a warning bell ringing loudly. Now let's delve deeper. As we dissect these skyrocketing prices, we're not just looking at market trends. We're peering into the psyche of investors who choose gold over other assets. A surge in gold prices means heightened anxiety in the broader economic landscape. The question arises, what's driving this trepidation? A significant factor is our very own Federal Reserve, the backbone of America's monetary system. Think of the Fed as the referee in a game of economic chess. Its primary tool? Interest rates, the price tag placed on borrowing money. When the Fed raises rates, the cost of loans skyrockets. Mortgages, car loans, business loans, they all become pricier, sending consumers and businesses into a tightening circle of expenses. Conversely, when rates drop, borrowing becomes more affordable, putting cash into the hands of consumers and investors. So where do we stand today? The market is buzzing with speculation, with an almost 90% probability that the Fed is poised to cut rates soon. But what does this mean for gold? Here's where the connection tightens. Gold, unlike other investments, doesn't pay interest. It simply rests there, glimmering, waiting. That's why, in a normal scenario, many would gravitate towards options like bonds or savings accounts that yield interest. However, when interest rates fall, those returns shrink, and suddenly the shine of gold becomes much more appealing. Let's illustrate this concept with a relatable analogy. Imagine you're at two restaurants. One used to offer a delicious dessert on the house, the other didn't. But now the first restaurant has taken away the complimentary dessert. Suddenly, both eateries start to look equally tempting. That's precisely the situation when interest rates decline. Gold emerges as a more attractive alternative, paralleling the allure of traditional interest-bearing assets. So, with every hint of a Fed rate cut, gold's appeal gets supercharged, like rocket fuel propelling it into the stratosphere. But the Fed isn't the only player in this story. Let's dive into another significant one in the economic landscape: politics. Recently, Donald Trump's tariffs have shaken up global trade once again, and the ramifications extend far beyond just trade relations. In simple terms, a tariff is basically a tax imposed on imported goods. When the United States decides to slap tariffs on products like steel, cars, or electronics, guess what happens? Prices for those same goods start to climb here at home. This rise in prices isn't just a minor inconvenience. It leads to inflation, a silent thief that gnaws away at your purchasing power like termites in your wallet, leaving you with less value over time. So, what do people typically do when they sense inflation creeping in? They search for protection, something that inflation cannot erode. And for thousands of years, that safety net has been gold. Think of it this way: each time the government rolls out new tariffs, it acts almost like a promotional campaign for gold, an urgent call to protect yourself before prices rise. And guess what? People are listening. As they witness prices hike due to tariffs, they flock to gold, willing to invest in something tangible that can weather the inflation storm. Now let's zoom out beyond America. Because gold isn't just priced in the US, it plays into the global economy. This year, we've seen the US dollar tumble by over 11%. That's a hefty drop by any standard. Now consider what happens when the dollar weakens. You're right. Gold gets an incredible boost. Why is that the case? Well, gold is priced in dollars globally. So when the dollar takes a nosedive, gold suddenly becomes less expensive for international buyers. Imagine if suddenly the iPhone you've had your eye on dropped 11% in price overnight. Wouldn't you rush to buy it? That's exactly what global investors are doing with gold. Combine a weak dollar with inflationary concerns and possible cuts from the Fed, and we have what looks like a perfect economic storm. It's a thrilling time for gold, and investors are responding in droves. Here's a twist that many might not be aware of. It's not just individual investors or traders rushing to buy gold. The heavy hitters, central banks, are in on this too. Countries like China, India, Turkey, and Poland are stockpiling gold at unprecedented levels. Why, you ask? Because they are actively seeking to reduce their reliance on the US dollar. Think about it. For decades, the dollar has been the king of global finance. But now, a shift is occurring when central banks are quietly building their reserves in gold instead. In fact, it's been reported that gold has become the second largest reserve asset in the world, trailing only the dollar. This is more than just a financial maneuver. It represents a geopolitical statement. Nations are signaling, we're hedging our bets. We won't put all our trust in the dollar anymore. And when the world's biggest financial players shift to gold, you better believe the price responds. Of course, we cannot underestimate the human element in all of this. Not everyone putting money into gold is making a calculated, strategic decision. Some are just jumping in because the price is going up and they don't want to miss the ride. This is what's known as FOMO, the fear of missing out. It's the same psychology that drives meme stocks or cryptocurrency bubbles. When gold crossed that exciting threshold of $3,500, social media exploded. Investors flooded into gold-backed ETFs, and suddenly, owning gold wasn't just savvy, it was trendy. But beware, there's a danger lurking beneath the surface. Bubbles can form when hordes of people dive in for the wrong reasons. Analysts at UBS suggest that gold could soar to $3,700 or even $4,000 if conditions keep favoring it. Yet as thrilling as those heights seem, remember that the higher it climbs, the steeper the potential fall could be once the excitement fizzles out. Let's circle back to the Fed, because here's where the story gets really tricky. The Fed has two primary objectives: ensuring prices remain stable and maintaining a robust employment rate. However, with tariffs pushing prices higher and the economy showing signs of slowing, we find ourselves in a precarious situation. A classic economic conundrum. Imagine this. If the Fed opts to cut interest rates, it risks igniting a fire of inflation that could spiral out of control. Conversely, if they hold rates steady, they might inadvertently allow unemployment to creep up, leaving countless individuals in a precarious position. It's akin to being caught between a rock and a hard place, a situation that economists know well. The Phillips curve dilemma. History has a way of repeating itself. When central banks find themselves ensnared in this predicament, gold often emerges as a beacon of safety. It's a tangible asset that doesn't fluctuate with interest rates or employment figures. Instead, It retains its value when uncertainty looms. In times of financial distress, gold shines brighter than ever, signaling that investors are on high alert. Now, let's take a step back and look at the broader landscape. Gold's record-breaking moment isn't the result of a single event. It's about everything colliding at once. We have the Fed signaling potential rate cuts, Trump's tariffs stirring the pot of inflation fears, and a weakening dollar painting the walls of uncertainty. Add to that the strategic move of central banks hoarding gold and investors jumping on the momentum bandwagon. When these elements intersect, they create a perfect storm that propels gold to unprecedented heights. But this phenomenon goes beyond mere statistics and price charts. It's about what gold is saying to us. People are anxious, institutions are taking precautions, and the very foundations of our financial system are under pressure. It's a call to action for everyone to reconsider their strategies and outlooks. So finally, let's entertain a thought-provoking question. What if we've reached the pinnacle of gold's climb? If this truly is the apex, it could signify that perhaps our fears are exaggerated, that inflation might stabilize, the dollar could stage a comeback, and the Fed may indeed find a way to navigate through these turbulent waters successfully. But what if this isn't the peak? What if we're merely at the beginning of a greater ascent, with $3,500 being just a stepping stone on our way to $4,000 or beyond? Such a scenario would likely indicate a storm brewing, more inflation, heightened uncertainty, and an increasing lack of trust in traditional systems. Regardless of which path we tread, the lesson gold imparts is clear. It's time to pay attention to the signals it sends. The financial landscape is shifting, and the question is, are we attuned to what's unfolding before us? Because at the end of the day, the choices we make today could define our financial futures tomorrow. As we wrap up this episode, let's take a moment to dive deeper into an intriguing perspective. Gold isn't just a shiny metal adorning our jewelry and wealth. It's akin to a living storybook. And right now, the narrative unfolding is steeped in themes of fear, uncertainty, and profound change. Whether you're an investor, a history buff, or simply curious, understanding gold's multifaceted role can provide valuable insights into our current landscape and shape our crucial decisions in everyday life. Thanks for joining me on this journey through the What If series here on BrainFuel Reads. If you found this helpful, make sure you like, subscribe, and hit the bell so you don't miss the next breakdown of the world's most important what-if scenarios. And remember, keep your brain fueled and stay curious, because the stories of tomorrow start with the questions we ask today. See you next time.